You know that old saying, don't put all your eggs in one basket?
Sure, everyone knows that one.
Right.
Yeah.
It's so simple. But when you get into investing, well, diversification often feels like this quiet, maybe even boring idea.
Yeah, it doesn't have the glamour of picking the next hot stock.
Exactly. But what we're going to dig into today is how it's actually this incredibly powerful, almost hidden superpower for your finances.
A silent power, you could say.
Yes, the silent power. This deep dive is all about showing how smart diversification isn't just, defense. It's about cutting risk way down and, maybe surprisingly, really boosting your long-term returns.
That's spot on. And for this deep dive, we're leaning on some real heavyweights. We're talking John C. Bogle, Benjamin Graham, David L. Dodd.
The foundational thinkers.
Absolutely. We're pulling the core ideas from their major works. Think of it like getting a roadmap from the people who charted the territory of smart investing. Our mission here is to really show how these timeless ideas apply directly to your financial journey. We'll hit some surprising facts, but also really actionable stuff.
Okay, let's start right there. Unpack this for us. What does diversify really mean? Because I think for a lot of people, it's just, oh, I own 5 different stocks, I'm good.
Right, that's a common misconception.
But Graham's work, it goes much deeper, doesn't it?
It really does. It starts with a fundamental shift in how you even view a stock.
Okay.
Graham's core idea is a stock isn't just a ticker symbol flashing on a screen. It's not just an electronic blip.
It's ownership.
Exactly. It's a piece of a real business. And that business has an actual underlying value that's separate from whatever the stock price is doing day to day.
Right.
Graham famously talked about the market acting like a pendulum, swinging back and forth.
Between what? Greed and fear, basically.
Pretty much. He called it unsustainable optimism when prices get way too high and unjustified pessimism when fear drives them way too low.
So the intelligent investor doesn't predict the swings.
No, not according to Graham. The intelligent investor is a realist. They use the swings. They sell to the optimists when things are overpriced and buy from the pessimists when things are on sale patiently.
That pendulum idea is really helpful. But it makes you wonder, if those opportunities exist, why is it so incredibly hard for most people, even pros, to consistently pick the winners?
That's the million-dollar question, isn't it?
And how does that difficulty make diversification so critical for us regular investors just trying to navigate things?
Well, it boils down to a fundamental challenge. It's just incredibly difficult, maybe almost impossible for the average person, or frankly, even most fund managers, to consistently pick a small group of stocks that happens to contain most of the big winners and avoid most of the big losers.
So trying to be selective is risky.
Very. Graham put it bluntly. For most people, not diversifying is foolish.
Foolish. Strong word.
It is. But think about why. As you own more different stocks across different industries, the damage any one loser can do to your overall portfolio shrinks dramatically.
Okay, it dilutes the impact.
Right. And conversely, your odds of actually owning some of those big winners, the ones that really drive market returns over the long haul, they go up significantly.
Just by owning more things.
Exactly. You're not trying to find the needle in the haystack anymore. You just buy the whole haystack.
I like that. But you own the whole haystack.
That's the core idea. That's the protective and actually return-enhancing power of diversification.
Okay, so playing stock picker is like financial roulette, as you said. What's the practical answer? The powerful solution that really captures this diversification idea and, actually works.
The practical, powerful, and really elegant solution is indexing. And this is absolutely central to John Bogle's whole philosophy.
The Vanguard founder.
The man himself. He didn't just suggest it. He called indexing the ideal choice for the vast majority of investors.
So how does it work in practice? Just buy one fund?
Pretty much. A single, broad equity index fund. Maybe one that tracks something like the Wilshire 5000, which is basically the entire U.S. stock market.
Okay.
That single fund has historically done better than the average actively managed fund trying to beat the market.
Better how? Let's talk numbers.
Okay, numbers. An index fund tracking the whole market captured about 99% of the market's annual return. Makes sense, right? It is the market.
Yeah, almost all of it.
Now compare that to the average actively managed equity fund. They consistently lagged the market by about 2.5 percentage points every year.
2.5%. Doesn't sound huge initially.
I know. It sounds small, like who cares? But here's the kicker. Over time, that's like you handing over a massive chunk of your potential gains directly to the fund managers and covering their costs.
How much difference did it make?
On just one initial investment over time, that seemingly small lag meant the index fund delivered an extra $23,500 compared to the active fund. The index fund's value was more than double the original investment just because of that cost difference. Think about that, doubling your money by picking the simpler, cheaper option.
That's incredible. No fancy strategies, just low costs and broad ownership.
That's the power, not through risky bets, but through patient, diversified indexing.
And you mentioned risk earlier. It's not just about returns, is it? How do index funds help with the bumps in the road, the volatility? That's huge for peace of mind.
It's absolutely critical. And yes, broad market indexes inherently carry substantially less risk than the average actively managed fund.
How much less?
Well, Morningstar looked at this. They measure risk using standard deviation, basically, how much the price jumps around.
Right.
And index fund risk was more than 30% lower than the risk taken by the average actively managed fund over a 5-year period.
30% less bouncing around.
Exactly. That means a smoother ride for you, less stress when the market gets choppy, and frankly, it makes it easier to stick with your plan long term.
And then there are taxes, the silent killer of returns.
Oh, absolutely. Bogle called it a huge toll. Index funds, because they're passively managed, are incredibly tax efficient.
Why is that? Low turnover.
Precisely. They don't buy and sell stocks constantly, they just hold the index, so very few taxable capital gains are generated and passed on to you.
Unlike active funds.
Exactly. Active funds are often wildly tax inefficient. Their turnover, how much they trade, averages upwards of 80% a year.
80%, so they're constantly buying and selling.
Constantly churning. And every time they sell a winner, that potentially creates a capital gain that you have to pay taxes on right now, even if you haven't sold a single share of the fund yourself.
That's crazy. Does it make a big difference in the end?
Huge. Look at the original Vanguard S&P 500 index fund. On a pre-tax basis, it beat 94% of its peers.
Very impressive.
But on an after-tax basis, it beat 97%. That gap shows you just how much extra drag taxes create in those active funds. What you actually get to keep is significantly higher with the index fund.
It's amazing that this whole idea, indexing, was once laughed at. Bogle's folly, they called it.
Incredible, isn't it?
How did it go from being ridiculed to being seen as, like you said, the hallmark of responsible investing? What changed?
It really is a fascinating story. When John Bogle launched the first index fund back in 1975, well, the whole industry was built on the idea that professionals could and should beat the market.
That was the whole point, right?
That was the whole pitch. So the idea of just matching the market, it seemed passive, lazy, even un-American to some. Seriously. Critics were loud. Bogle's folly stuck. But Bogle was absolutely convinced that costs were the enemy of the investor.
And he stuck with it.
He did. And slowly, painstakingly, over decades, the evidence just piled up. The lower costs, the better performance after costs, the tax efficiency. It became undeniable.
The data won out.
The data won out. And eventually, even the critics had to concede. It just worked better for most people.
And it wasn't just Bogle saying this, right? I mean, other big names in finance, even famous stock pickers, eventually came around.
Oh, absolutely. Some of the biggest legends, people who made their names managing money actively, ended up endorsing indexing.
Like who?
Peter Lynch, legendary manager of Fidelity's Magellan Fund, probably one of the best stock pickers ever. He famously said, most investors would be better off in an index fund.
Wow. Coming from him, that's powerful.
Isn't it? Or Charles Schwab, founder of the brokerage giant. He pointed out only about 1 out of every 4 equity funds outperforms the stock market. That's why I'm a firm believer in the power of indexing.
So the pros themselves recognized the odds were stacked against them and against investors paying them.
They saw the results, the real-world data over long periods. It wasn't just theory. It was proven practice.
Okay, so with all this evidence favoring low-cost indexing, why do so many funds still try to actively beat the market? And what are the hidden costs that keep tripping investors up?
Well, part of it is the allure, the marketing story. But fundamentally, as we touched on, it comes down to 2 things. A practical lack of real diversification in many active funds, and the high costs.
Let's talk about those costs again. Turnover seems key.
It's huge. The turnover rates are just staggering. We mentioned the average fund manager turnover is around 85% per year.
Meaning they replace almost their entire portfolio every year.
Pretty much. This constant rapid-fire trading, as Bogle called it, generates enormous hidden costs for you, the investor.
Hidden how? Like Brokerage commissions.
Commissions are part of it, but also bid-ask spreads, market impact. Basically, every time they trade, there's friction, and that friction costs money. Bogle called them enormous portfolio transaction costs. And then there are the tax costs we already discussed.
And these aren't usually listed in the expense ratio, right? They're on top of that.
Exactly. That's why they're insidious. Bogle's son, Jack Bogle Jr., actually researched this. He found transaction costs could be around 0.6% for some stocks, but jump to maybe 1.8% for others, like small growth stocks. A good general estimate might be around 0.8% of the value traded. Now think about that 85% or 100% turnover.
So if turnover is 100%, that's 0.8% in transaction costs.
Well, you buy and sell, so it's often closer to double that friction cost, maybe 1.6% per year just in trading costs.
Wow.
Now, add that 1.6% trading cost penalty to the average active funds expense ratio, which is maybe 1.5%.
So 1.6 plus 1.5. That's over 3% per year.
Exactly. Bogle called this the aggregate fiscal drag. Over 3% of your investment potentially vanishing each year before you even consider performance relative to the market.
So if the market makes 10%.
You could lose almost a third of that return right off the top to costs and fees. It's huge. This is why Bogle hammered home costs matter.
Okay, show me more. How much does that percentage point or so, as you said, really impact things long term? Because 1% sounds tiny.
It sounds tiny, but compounding makes it enormous. It's one of the most eye-opening things in Bogle's work.
Give me an example.
Okay, take a simple balanced fund, part stocks, part bonds. Compare a low-cost one, maybe 0.2% expense ratio, to a typical active one at 1.0% expenses.
So a 0.8% difference per year.
Right. Seems small, but start with the same amount, let it run for 50 years.
Okay.
The low-cost fund grows to $578,000. The higher-cost fund, only $449,400.
Wait, that's a difference of nearly $130,000.
It's $130,000 vanish just because of that seemingly small 0.8% annual cost difference. That's a retirement nest egg difference right there.
Just gone to fees.
Gone to fees. And it's not just in good markets. Even when markets are down, low-cost funds protect you more. Lowest-cost large-cap funds lost about 1.1% less than the highest-cost ones in tough times.
So you win more when things go up and lose less when they go down.
Costs matter, always.
Okay, another trap seems to be chasing past performance. You know, picking the fund that did great last year, that doesn't work either.
It's one of the biggest mistakes investors make. The data is crystal clear. No evidence, none that superior past performance is predictive of future success.
None. Yeah.
None that holds up consistently. What you do see consistently is reversion to the mean.
Meaning winners tend to become average or worse.
Exactly. Hot funds cool off. One study showed 73%, almost three-quarters of the top-performing funds from the 1990s fell back to average or below average in the 2000s.
They couldn't keep it up.
They couldn't. There's a famous, almost painful example, Legg Mason Value Trust.
I've heard of that one.
It beat the S&P 500 for 15 years straight, 1991 to 2005, an incredible run everyone wanted in.
The must-have fund.
You'd think. But then, from 2006 to 2008, it underperformed the index by a staggering 43 percentage points.
Ouch. 43% behind.
Shows how quickly things can reverse. Chasing yesterday's winners is often a recipe for disappointment. Graham's data showed this too. The percentage of funds beating the market shrinks dramatically over time. Maybe 49% beat it over 1 year, but only 15% over 20 years.
The longer you look, the worse the odds get for active management.
Precisely. Time is not on the side of high-cost active strategies.
Which brings us back to what you call the tyranny of compounding costs. It sounds bleak, but it highlights how these small drags just eat away wealth.
It sounds bleak because the effect is bleak for the unprepared investor. Those small differences in costs and taxes compounded year after year lead to increasing and finally staggering differences in capital accumulation.
It's insidious because you don't see it day to day.
Exactly. You don't feel that 1% expense ratio or the taxes on turnover each year. But combine them, the fund costs, the transaction costs, the taxes generated by active trading. One analysis Bogle highlighted was shocking. Comparing a pre-cost, pre-tax market return to what an investor might actually keep from a typical mutual fund after costs and taxes over 40 years.
As a result.
The investor's final pot of money was only 23% of what the raw market return would have suggested.
Only 23%, so nearly 80% of the potential growth evaporated.
Evaporated. Wiped out by costs and taxes compounded over decades. It's like a slow, invisible bleed on your financial future. That's the tyranny.
Okay, so we focused heavily on diversifying within stocks using indexing. But how does this whole idea expand? What about your entire financial picture, zooming out beyond just stocks?
Right, great question. When we zoom out, we're talking asset allocation. That's the mix between different types of investments, mainly stocks and bonds.
And the basic idea there.
The basic principle is pretty straightforward. As you get older, you generally want to reduce your exposure to stocks, which are more volatile, and increase your holdings in bonds, which are typically steadier.
To reduce risk as you approach retirement, for example.
Exactly. And this isn't just theory. Bonds proved their worth massively during big downturns like the 2007-2009 crash. While stocks were getting hammered, bonds actually provided positive returns for many investors.
So they acted as a shock absorber.
Perfectly put. They moderated that risk, providing stability when the stock portion of the portfolio was under stress. Think of them as the anchor.
Okay, and even within stocks, not all stocks are the same risk level, right?
Mm.
Can you diversify within your stock allocation too?
Absolutely. Risk varies quite a bit. For example, large cap value funds, think big, established companies, maybe paying dividends.
Wow.
They tend to have lower volatility. Their standard deviation might be around 9.8%, much calmer.
Compared to?
Compared to something like small cap growth funds, these are often smaller, potentially faster growing, but more speculative companies. Their volatility can be almost double, maybe 18.7%.
So much wilder swings.
Much wilder. Understanding these differences lets you build a stock portfolio that reflects your own comfort level with risk, diversifying not just across companies, but across types of companies too.
And what about going global, investing outside your home country? Does that add another layer of useful diversification, say, for a U.S. investor?
That's often debated, especially for U.S. investors, since the U.S. market is so large and diverse already.
Right, some say you don't need it.
Some do,
Mm.
but the Bogle principles still apply. If you do want international exposure, low-cost international index funds are almost certainly the much better way to get it.
Better than active international funds.
Yes, for the same reasons, cost. We see the same pattern. A low-cost total international index fund outperformed the average actively managed international fund by about 1.2 percentage points per year.
And that was mostly due to costs again.
Largely, yes. The index fund might have an expense ratio around 0.34%. The active fund, maybe 1.31% plus transaction costs, estimated around another 1%. So again, a huge cost hurdle for the active fund.
So diversifying globally with low-cost index funds can potentially boost returns and lower overall risk, but spreading bets across different economies.
Exactly. It adds another layer to that diversification shield.
Okay, so let's bring this all together. We've covered a lot. What's the main takeaway for you, the listener, trying to make sense of all this for your own financial future?
I think it really boils down to embracing the elegant simplicity of effective diversification.
Simple but powerful.
Incredibly powerful, even if it's silent. It might not be flashy. It doesn't give you bragging rights about picking the next Amazon. But its silent power, achieved through low-cost, broadly diversified investments like index funds, has just consistently proven to be superior for building long-term wealth for most people.
It's about capturing the market's return efficiently, not trying to beat it and paying dearly for the attempt.
Exactly. It's about securing your future with wisdom, with evidence, not speculation and high fees.
So here's the final thought to leave everyone with. Given this overwhelming evidence, decades of it showing the power of diversification, low costs, indexing, why do so many investors, and frankly so many financial products, still seem to ignore these basic common sense principles?
That is the perplexing question, isn't it?
What do you think it would actually take for the financial industry as a whole to truly align its interests with yours, the individual investor trying to build a secure future?